that one there called the VX30 to VIX roll yield, let's use that metric to actually start making some money. So the VX30 to VIX roll yield is a representation of how much these front 2-month VIX futures are above the VIX index. This is important because remember, the volatility ETFs like VXX, UVXY, SVXY, there's many of these, they derive their value entirely based on the price of those front 2-month VIX futures. But another thing we know is that on expiration day, that front month VIX future will be equal to the VIX index value. This happens every month. Just for that one day on expiration, they will be the same value. So it makes sense that if these front 2-month VIX futures are trading above the VIX index, then over time they have a higher probability of decaying down to match the VIX index at expiration. This situation would be a tailwind for the short volatility trade. So I have a metric that I call the VX30 to VIX roll yield that measures how far above the VIX index those VIX futures are trading. The point is, in my opinion, there is no better way to consistently beat the stock market than to have a really good understanding of the volatility complex. Using my volatility metrics in a systematic, rules-based manner is the best way to get an awesome long-term rate of return.